Hi, good morning, everyone. Good morning, good evening, depending on where you are joining from. This is Amit Maheshwari. Welcome to the webinar on the Union Budget 2025 by AKM Global. I will quickly start with a 1-minute introduction about our firm and some initial thoughts and comments about the Indian budget, which was presented by Honorable Finance Minister for a record 8th time. So our firm is a firm of 650 professionals headquartered in Delhi NCR, but having offices and operations all across India. We focus on cross-border transactions. However, we are a full service firm wherein we start right from identifying joint venture partners, helping in brownfield, greenfield acquisitions, as well as taking care of bookkeeping, compliances, transfer pricing, audit, and taxation. This has been an annual ritual, and we are very pleased to have record number of attendees this time as well. So the backdrop in which this budget was presented was that Indian economy was going through a definite cyclical slowdown, and our currency was under immense pressure due to upcoming or expected tariffs by Donald Trump's regime, and also because of strengthening dollar, a lot of emerging market currencies were under pressure. So one view in the market has been that, of course, India will definitely depreciate, the currency would depreciate, and it is required as well, because in India, to maintain export competitiveness vis-a-vis other emerging markets, we need to become more competitive by loosening our currency, and also to somehow dilute the impact of the tariffs. So with this, our finance minister has done a commendable job. She has presented a very balanced budget. The economy was slowing down and consumption was taking a hit. So she has put in more money in the hand of the middle class. And we think that this is a very good move and would be a game changer. There are four focus areas of this budget. One is agriculture, then it is medium and small enterprises, then investments in the economy, primarily through capital expenditure, as well as exports. So with this in mind, we'll come to the direct tax proposal. The intention is to discuss the direct and indirect tax proposals. So just as a backdrop, in the last 10 years, the government has implemented several reforms for the convenience of taxpayers, which have been faceless assessments, Vishwas se Vivad schemes, faster processing of tax returns. We all know refunds have become so quick now. 99% of the assessments are now self-assessments instead of very intrusive scrutiny assessments. And there has been a taxpayer charter also, which has been very welcome. So this government, and which was again stressed in the speech of the Honorable Finance Minister, that they want to trust first and scrutinize later. So that's a game-changing approach. That is what the tax department has been following. And if you look at some of the provisions which we will discuss today, we will see that how the government is trusting all the taxpayer first and then thinking about scrutinizing them. One key, let's say what we are all professionals looking forward is that we have a new direct tax bill which will be presented this week. And we expect the direct tax bill to be much simplified. It would be almost half in length of what the current tax code is. So at the end of our webinar, we'll probably discuss some expectations out of this direct tax bill. Unfortunately, it won't be open for public consultation. As we understand, it would directly be tabled in the parliament and would be passed as a bill. So not expecting too much, but still we will discuss a few points. Coming to the direct tax proposals, I think this government, and while framing this budget, they had a few things in mind which clearly comes out of the budget proposals. One is the personal income tax reforms. There have been a lot of reforms and good tax savings exemptions provided for middle class. So the personal income tax reforms have been done with a special focus on middle class. TDS and TCS provisions have been rationalized, and voluntary compliance, as I said, has been encouraged. And most importantly, they have tried to reduce the compliance burden wherever it is possible. The customs proposals tend to rationalize, they are more towards rationalizing tariff structure and address duty inversion. And all of this should ideally, their intention is to support domestic manufacturing, promote exports, try to provide relief to common people. So that has been the overarching objective. So I will come to the direct tax proposals. We'll start with corporate tax proposals, and then we have my colleagues will touch upon the personal tax proposal as well as indirect tax. Today, I have with me my partner Sandeep Sehgal in direct taxes, Manish, who leads our transfer pricing and litigation practice, Ikesh Nagpal, who leads our indirect tax practice, and Vikas and Chetna from our transaction advisory department. So, starting with the corporate tax proposal, one of the key changes this time has been that there is a particular section in the Income Tax Act which talks about carry forward of losses in case of amalgamation and reorganizations. As of now, as the law states that once you have done an amalgamation, the successor entity gets a fresh lease of 8 years of carry forward of losses. The losses are deemed to be created in the year in which the amalgamation is affected. Therefore, they are able to carry forward that for the next 8 years. In this budget, the proposal has been they want to restrict that. They want to restrict this evergreening of losses and want to make sure that it is not utilized for purposes which were never meant for. So what they have said is that the losses, the 8-year limitation would start from the first year or from the year in which the loss was created at the predecessor entity level. So if let's say you had 3 years of losses, then you did an amalgamation. So the new entity will only get 5 years, unlike earlier where they would have got 8 years. This even though the intentions are pretty clear and they are it's commendable, but some of the cases, genuine cases where earlier government wanted to give certain benefits and to successor entities in IBC, where they wanted to make sick companies good and make them more attractive for foreign buyers. I think in that case, can you just go to the first slide, please? So in those cases, unfortunately, it would get hit, and this might reduce the attractiveness of the entities which are being sold off. Under the startups, startups get a very favorable tax regime in India. They get a benefit of 100% tax exemption for a period of 3 consecutive years in a block of 10 years. Now that benefit was available only if you incorporated till 31st March 2025. Now this has been extended to 2030. So you can still now also set up startups and can benefit from this exemption. There are, of course, condition attached to it. You need to have an interministerial departmental certificate and stuff like that. But the benefit has been extended, and good thing, which we will come to it later also. What the government has done, they have this time extended everything by 5 years. Most of the benefits by 5 years instead of doing incremental year by year. So this gives a lot of certainty, because earlier every budget they used to increase by 1 year, and we had to tell our clients that look, we expect this to continue because every year they have been extended. Now at least we can say that look, this is now for 5 years, take your time, and this would be available going forward. There was also a concept of significant economic presence, which is a domestic tax act concept, wherein if a foreign company sells goods and services in India, they subject to certain conditions, they might be treated as having a significant economic presence in India. Now, if a non-resident uh, has operations in India, they can choose to be governed by the Indian Income Tax Act or the tax treaties, whichever is more beneficial. The significant economic presence is a concept of the Domestic Act. It is not a concept found in the tax treaty. This was brought in due to OECD BEPS Action Plan 1. There was an anomaly here. Mere purchase of goods and services for the purposes of export was not exempted in significant economic presence. It was not an exclusion here, unlike the business connection definition under Section 9 in the Indian Income Tax Act. To make it more align both the definitions, they have now brought this exclusion in this definition of significant economic presence. But please remember that even when you are coming from a treaty country, this definition really does not matter, because the treaties are more beneficial as of now. I mean, or if you are coming from a treaty country but you are not eligible to take treaty credits because probably you can't have a you don't have a tax residency certificate. So only then this is applicable. Can we go to the next slide, please? Yeah, so we have a tonnage tax scheme for shipping, and this is more of a rationalization measure and providing a benefit to inland water transport. So Mr. Nitin Gadkari over the last several years have been pushing for inland water transportation, saying that it is a very cheap mode of transport, and India fortunately has a lot of rivers, tributaries. Uh, so he believed, and obviously the industry is also doing their bit by making inland water vessels and inland waterways a key method of transportation within India, and it turns out to be pretty cheap. So they have just extended the tonnage tax scheme on inland vehicles also. Then there are some procedural elements of taking the approval of the Joint Commissioner, which probably is more procedural nature. But the main thing is that they have extended it now to inland water vessels as well. Um, they have also brought in a presumptive taxation for non-residents which are engaged in electronic manufacturing. I think, as we all know, there is a PLI for electronic manufacturing. After oil, the second biggest foreign exchange expense of India is electronics, and India wanted to save on foreign exchange and wanted to increase the electronic manufacturing in India. We have a lot of success stories. We have the likes of Dixon. We have a very good PLI scheme. So now the government has provided one more benefit. They have said that if you are a non-resident providing services to electronic manufacturing players, they will deem only 25% of the revenue as taxable profits. And then there is a 35% tax rate, which takes the effective tax rate to less than 10% of the revenue. It's probably even lesser than the tax treaty rates in many cases. So this is a good benefit, really solves a lot of things. You really don't need to make elaborate books of accounts and stuff. So you can just take care of this, take this presumptive taxation scheme and get this beneficial rate of taxes. Now, there's a new section which has come in 285 BEAA on virtual digital assets. So herein there is a reporting format which has been prescribed, and there are reporting entities which again would be prescribed in due course, but we all understand it would be the exchanges and the other intermediaries, which would be required to report crypto assets to the government. The government then would exchange it under the automatic exchange of information between various countries. So India hosted a G20 summit, and that in Delhi, New Delhi, and G20 countries decided that we need to have an exchange of information, automatic exchange of information of all crypto assets in different jurisdictions. Again, because of the nature of crypto assets, you can share it, you can pull out the crypto assets into your cold wallet, you can then again put it on an exchange. It can transverse borders very easily. Therefore, you need a robust mechanism to report crypto assets. We also believe that with these reporting of crypto assets, the government will get information which they otherwise were not privy to, and they would be able to match that with what has been reported in the tax returns by several taxpayer, or if not, even if not reported, they might ask questions about this. So this will help in ensuring greater transparency and also enhancing the tax base. But it has come due to India's commitment to the automatic exchange of information. And this obviously this will be operationalized and the rules would be notified. Can we go to the next slide? Yeah. So there have been several changes in international IFSC, which we probably call the gift city, wherein the government has provided certain concessions to the financial services industry. Um, a lot of provisions which were there have been again extended by 5 years. Like I said, it's a good thing. Got a straight away 5 year extension. Gives a lot of certainty. So several such provisions have been extended: leasing of aircrafts, capital gains, investments, capital gains exemptions, and income attributable to investment activity. They all have been extended. Now, there are a few other things which have happened. So there was an exemption of capital gains for aircraft leasing. They have extended that to ship leasing also. Um, so both capital gains and dividend have been extended. There was an exemption for aircraft leasing. Now it has been extended to ship leasing also. Now, again, all these are good moves. There are small procedural matters. Several small sections have been amended. We probably won't go through that. We just cover some substantial provisions which can really have an impact and can be a game changer for attracting more companies in IFSC. Can you go to the next slide? So offshore derivatives, again, it was for offshore banking units, it was all exempt. Now they have extended it to foreign portfolio investors. So all offshore derivative instruments, NDFs, over-the-counter derivatives, that exemption has been now extended to FEIs. Fund managers, there have been some small changes on the eligibility of fund managers. They have been given 2 dates and a grace period to be compliant. Again, this will probably help them. They will provide some flexibility, and it will give them some breather. Again, it's a different story that probably not many fund managers are there, but IFCs have been picking up, and I hope hopefully they will find a lot of takers. Next slide, please. So a lot of companies in IFSCs, and that is one of the industry which they want to attract also. They set up their global treasury centers in IFSC, trying to service the entire global group. Because of that, there's a lot of money movement. And under the Indian laws, movement of money from one company to another, especially when it is a closely held company, can be treated as a deemed dividend under Section 222E. They have given an exemption saying that this deemed dividend would not be applicable when it is a transaction between two IFSC companies. They have again prescribed certain restrictions. One of them is that the IFSC entity has to be a global or a regional treasury center. They have to say that. And the parent entity must be listed on a foreign stock exchange. Again, these should be all kosher first jurisdictions, not through jurisdictions where they're FATF gray list, blacklist. So in those cases, they will definitely provide this exemption. They have also made it tax neutral for relocation of funds, certain funds. So important to consider retail schemes and ETFs for India-centric funds that would also, if they are relocating from a foreign jurisdiction to IFSC, it will be made tax neutral. So if you are setting up a ETF, you had an ETF overseas, you now want to shift it and relocate it to the IFSC, they have made it tax neutral so that more and more players can take advantage of it. Next, please. So I think there are certain provisions on funds and business trust. I think due to paucity of time, I'll just summarize them in one or two lines. So first one is that there have been some rationalization in terms of taxation of business trust, which are your REITs, InvITs. If they have cap gains, they have special incomes. It has been increased from 10% to 12.5%. Again, this is in line with what tax rate other taxpayers face. Um, the same has been, and there was a section 11580 which talks about income from certain securities for funds and for FIs and specified funds. Again, 10% to 12.5% they have made it. This all they're brought in for parity. Also, very importantly, domestic AIFs they've said that if you sell securities, if you're a category 1 or 2 AIF, if you sell securities, it would be treated as capital gains. There were a lot of controversy whether it is a business income, cap gains income. They've said that we will treat this as capital gains income. So again, this is beneficial. Clients now funds would have clarity, and there will be no further litigation in this regard. Yeah. So this is like couple of good amendments. So for small trusts which have which have less than 5 crores of total income for 2 consecutive years, their registration would be given for 10 years and not 5 years. So earlier, every 5 years, you need to renew that. Now it would be for 10 years. So again, for small trust, this will reduce their administrative burden, their compliance requirement, and they can really do what they intend to do. They can focus on their charitable activity instead of trying to renew it every time and finding issues in that. In India, there has been a massive crackdown on a lot of charitable institutions, especially which are foreign funded. Uh, I think these are all things which are probably welcome where you have really genuine trust, small trust, which don't have the wherewithal to do so much of compliance. Also, one important change earlier, even if there was some small issues in your registration documents, it was treated as if it is a violation, even small violations, which resulted in cancellation of the registration. Now, the government has said that if you have provided incomplete information at the time of application, it would not result in the cancellation. It is not a reason enough for cancellation of your registration. Again, obviously, commissioners would look into more details and see why you have to explain why you did not put in full information, but you can really make it good. It's not something which as if will result or undo everything good what you have done. Next, please. Yeah. So another benefit which they have given is that they've increased the threshold uh, for a substantial contribution. So in charitable institutions, if you do an application of income to certain specified people, it is not treated as a legal specified contribution, and you could lose your tax break on that. It can get taxable. Now, this is when you try to give money to the trustee or relatives or entities controlled by them. So what they have said that first they have increased the threshold, and then they have also relaxed the scope. So relatives or donors would not be covered, and entities where they have significant interest would also not be covered. So you can provide or you can give money to them, and that would be treated as an application of income. Sovereign wealth funds have been very successful. Obviously, we have the Abu Dhabi fund, which is and the Canadian CPDQ. So a lot of sovereign funds have been very successful. They were provided certain exemptions. Again, their deadline has been extended for 5 years. And most importantly, there was a section which came last year, 50AA, which treated unlisted debt securities like MLDs as short-term capital gains, even if you held it for long term. Because of that, sovereign wealth funds were not enjoying tax exemption on such capital gains. They have now specifically mentioned that even if it is a short-term capital gain under Section 50 AA, it would still be exempt for the sovereign wealth funds. So again, probably a welcome move, and this is something which was required. These people are very long-term players doing or investing for the long term and helping the Indian economy. So I think we should do everything to attract them. So with this, I hand it over to my partner Sandeep for taking you through the personal tax proposals. Please, Sandeep, over to you.
Yeah, okay. Thank you, Amit. Yeah. So at as Amit mentioned, I think this has been a very good budget for the middle class, and I think this is the first amendment. I mean, this is the amendment which has interested the middle class a lot, and has been considered as the highlight of the overall budget. And this was something which was very much unexpected. Obviously, every time representations go and every time people tell that okay, this should be the slab should be increased, the limits of ATC etc should be increased, but I think uh, increasing the making an income up to 12 lakhs tax exempt, I mean this was something which is unprecedented and at the same time unexpected as well. So I think from that perspective, I mean this has been really really a great move, and I think this infuse a lot of buying power in the hands of the middle class. I mean, which could definitely help the economy from overall perspective. I mean, it could go to investment or discretionary spending, which will ultimately help the economy. So, as can be seen from the screen, that the slab rates have been considerably amended. I mean, earlier, typically we used to have a slab of three at the end 3 lakhs or 2 lakhs, but now the slabs actually have an interval of 4 lakh, where after every 4 lakhs, the tax rate changes. And the result being that earlier, when an income above 15 lakhs attracted at 30, attracted a tax of 30%, now that limit goes as far as to 24 lakhs, which I believe is a great saving in the hands of every single individual and HUF taxpayer. Likewise, the rebate under Section 87A has been amended, wherein effectively, as has been said, that if somebody has an income up to 12 lakhs rupees, and if you include 75,000 standard deduction under the salary income, effectively you would not be paying any tax due to availability of this rebate under Section 87A, which was earlier 25,000 and now it has been increased to 60,000. However, there is still a catch here, that this is something which happened last year as well, uh, when the people who actually filed their returns by 5th of July, they were able to take the rebate from capital gains income as well. And a dramatic turn happened when the income tax department changed the utility, that and everyone who filed the return after 5th of July, they were not able to take this rebate from capital gains income. And I think there were some petitions in the Bombay High Court where the matter went into the favor of the taxpayer, the but I think this is something which has been overruled by this amendment. And I mean, even if you I mean, even if you read the wordings of Section 115 BBC, where this slab has been provided, those wordings itself start with wordings like notwithstanding anything contained in any other chapter. So I mean, without prejudice. So effectively, which means that you have to give regard to the provisions of other spatial rate provisions in this particular chapter. Then only you will need to harmonize 115 BBC and other provisions like 112 12A and similar other provisions. So the thing is that you need to be mindful if you are earning a capital gains income, and which is in the overall limit of 12 lakhs, you may not be able to utilize the rebate fully. The second amendment, which is also a welcome amendment, is for the calculation of perquisites for the salary income. I mean, the limits which were there for the purpose of calculation of perks applying to employees who have an annual salary of 50,000 or 2 lakhs. I mean, these limits were set in 80s or the 90s, and obviously these were not in sync with the current economic realities. And I think the way this amendment has been done, that has also been very pragmatic, where the parliament will basically delegate the power to the central government, which means that it would be really be easy for the central government to notify these limits from time to time, and they will not need to propose this amendment to finance act all the time, which is generally, I would say, a time consuming process. Uh, Next slide. Yeah. So other amendment, important amendment is related to the NPS Vatsalya scheme. I think this was a scheme which was introduced last year itself, where uh, I mean, if you talk about NPS scheme, you can basically invest. It's a pension scheme where you can invest your money into equity instruments. Obviously, there would be a fund manager, and there are both the options like active management, passive management. Uh, Now, the similar scheme has been introduced where anybody would like to contribute in the NPS scheme for their children. That's why the name Vatsalya. Uh, and the scheme was introduced, and to bring parity with the current NPS scheme, this scheme has also been allowed with the same kind of tax incentive. That is, if you contribute in the name of children in this NPS Vatsalya scheme, you would get the reduction under 80 CCD of rupees 50,000. And like the ordinary NPS scheme where you withdraw your sum up to 25%, that generally remains tax exempt. Similar benefit has been granted in this case as well, that if you withdraw any amount up to 25% from the NPS Vatsalya scheme, that would not be taxed, but but if the withdrawal exceeds a particular amount, then the amount becomes taxable. The other amendment is relates to the self-occupied property, and I think this is something which is not any incremental benefit as such. The amendment was brought last year where you could consider two of your properties as self-occupied property. The only difference being that earlier you had to justify that both the properties were in different cities, uh, probably maybe having some geographical distance between them, because there could be a scenario where you have a house in your hometown on which you have taken a loan, but you are staying at another place for your business, for your business or your employment, and you could have taken a loan on that amount as well, on that property as well. So the government brought a relief last year that you could consider two of your properties as house properties and claim a deduction of 2 lakh rupees as interest for the same. Now this has been provision has been liberalized, so that earlier you were required to give a reason for the same, but that restriction has been removed in this particular year, though, so that if you have two house properties, both of the properties which you are not using for any reason, you're not required to justify that why you are paying it for two different houses, whether these are for self-occupied or not. You could claim both these houses as self-occupied and claim the reduction of 2 lakhs as interest on the loan for these properties. And I think the other important aspect related to this provision is there is some kind of vagueness as to whether you would be able to claim 2 lakhs for each house, or 2 lakhs is a limit for both the houses taken together. I think this is something, and if you read the wordings of the provision itself, I think the wordings are kind of clear that you could only take for one house of property, but it's better that if there is some kind of clarification from the government as well in this regard. Yeah. So can you move on to the next slide? Right. So the other important amendment is with respect to the National Savings Scheme. I mean, this is the scheme which was introduced, I think, in late 80s, and deposits were allowed till 1st April 1992, and the scheme basically taxed any kind of withdrawal from this particular scheme, except if it was by the legal years at the time of the death of the depositor. Uh, so I think what has happened is that in this particular scheme, Uh, the the government notified on 29th of August 2024 that from 1st October 2024, this scheme will stop bearing any interest. So obviously there was a need for the depositors to withdraw from this particular scheme. And but the thing is, the way the provisions were worded, if you withdraw any amount from the scheme, that would get taxed, and this would basically create an discomfort for the depositors, that they would not be earning any interest, but and they would also have to keep the amount reinvested as such. And I think this has been rationalized so that if you have withdrawn any amount after 29th of August 2024, those withdrawals will not be subject to any tax. The other important amendment is with respect to the ULIPs, basically the unit linked insurance plans. So this is also kind of, this was also brought for kind of to remove an anomaly as such. I mean, the provisions with respect to taxation of ULIPs have been amended several times. In 2021, there was already an existing condition that if the premium if the premium of the policy exceeded 10% of the sum assured, uh, that any kind of uh, surrender from this policy or maturity from the policy would not be tax exempted. Uh, and then in 2021, there was another condition imposed specifically for ULIS, which provided that if the annual premium of the policy exceeded 2,50,000, then even in that particular regard, that amount, that policy would not be considered as an exempt withdrawal, which kind of created an anomaly wherein your amount may not be exceeding 10% of the premium, but if the premium exceeded 250,000 annually, this amount could have been taxed as other sources income. And there were different views that why it should a ULIP should be treated as a capital asset and why should it be treated as an ordinary traditional insurance plan. So I think is the kind of anomaly which has been removed now. And as you can see from the table that if you comply both the conditions, that is if the annual premium does not exceed 250,000 and the premium does not exceed 10% of the sum assured annually, it will remain exempt. Otherwise, if any of the condition is not complied, then this would be subject to capital gains and accordingly period depending on the period of holding would be taxed as long term, short term as the case may be. So we can move on to the next slide. Yeah, the other important rationalizations are with respect to the TDS, TCS rates. I think these limits were existing for a very long time. And I think in this particular year, a lot of rationalization has been done. For example, most important being the interest on securities, which would really help the senior citizens. And considering that now that income up to 12 lakhs ordinarily will not be taxed in the hands of senior citizens, including their pension and other incomes like interest and etc. So, anyways, there is a need to increase this limit of interest. Earlier, this was 50,000 for the senior citizen. Now, this has been increased to 1 lakh, which I would say that would really help the senior citizens in managing their cash flow and provide them a financial cushion. Similarly, there have been rationalization in respect to other provisions like dividend. The limit for dividend has been increased from 5,000 to 10,000. Similarly, for mutual funds, it has been increased from 5,000 to 10,000. Uh, and even if you talk about the incomes like lottery, horse etc., the earlier the limit was 10,000 annually. Now this has been rationalized to 10,000 per transaction, which means that earlier it actually posed a lot of administrative burden on the businesses who were actually handling these lottery and horse businesses. Now it would really uh, remove some administrative burden from them and they would be required to do this withholding only if they are paying certain amount in a particular transaction. Then they don't need to calculate these annual limits for the winners in this case. So we can move on to the next slide. Similarly, limit for insurance commission has been increased from 15 to 20,000. Similarly, for commission for lottery tickets, 50, again increased from 15,000 20,000. Another important amendment is respect to TDS on rent. Earlier, the limit was too low, that is 2,40,000 annually, but now this has been increased to 15,000 per month. which means that this is not a limit of 6 lakhs annually. The thing is that even if it is for a part of the month and the amount does not exceed 6 lakhs annually, but if the rental exceeds 50,000 in a particular month, then the payer would need to do the withholding for that particular month when paying the rental to the payee in this case. Similarly, for professional services, this has been increased from 30 to 50,000. Similarly, for compensation provided by the government on acquisition, it has been increased from 2,50,000 to 5 lakh rupees. The other important rationalization is respect to the liberalized remittance scheme, uh, wherein wherein the banks and tour operators and other similar businesses were required to collect TCS from the depositors or the payers at a time when these remittances were being made. Uh, the limit sets were around 7 lakh for the, I mean, earlier the limit was 7 lakh. Now this has been increased to 10 lakhs, which I think is something which is reasonable. The another important amendment is respect to the education amounts and for education purposes. So if you have taken a loan from a bank or a financial institution in India, and you're sending an amount, you were sending an amount more than 7 lakhs, the TCS rate was 0.5%. So anyways, the amount was very low. But now this has been further realized that if you have taken a loan and you are sending that money overseas for the purpose of education, so that amount will not be subject to any TCS. So I think this is a great relief to the students and their families who have been planning to study or already studying abroad. So we can move on to the next slide. Yeah. So these are other important amendments with respect to the TDS and TCS. For example, for forest produce, nothing significant except that the definition of forest produce has been included. Uh, the other important amendments with respect to TCS on sale of goods. So like I think in 2021, uh, TCS was brought in for say for sale purchase of goods as well, and there was kind of a dual collection of withholding assets because you had provisions under like 194 QRS where you were required to do withholding as well, and the other party is required to collect TCS as well. The ultimate purpose of the mechanism of TDS and TCS is basically to track the transaction. I think having using both the provisions as such would not make much sense, and and it actually included it actually required a lot of administrative hassle on the part of businesses to comply with these provisions. So I think this is something which has been rationalized now that these such kind of transactions would not attract any TCS. However, the wordings are specified goods, so there is something which is need to see that which goods will be notified for this particular purpose, meaning that the provision would remain continue to apply for certain goods. But till the time that limit is that notification is done, we would not be able to really make out. Uh, the other important provision is respect to the security receipts of asset construction companies. So let's say if someone has purchased those units and they're getting any income from those securities. So those kind of securities attracted at TDS of 25% on 30%, depending on different scenarios. So now this has been rationalized and this would attract TDS only at the rate of 10%, which would actually affect the immediate tax outgo for the receiver in this case. Anything this is something which would really help the asset construction companies to gather the security receipts from the depositors. So we can move on to the next slide. So so this is regarding the TDS for the non-filers. I think this is also one important rationalization which has been done. The onus was on the payer that if the payee has not filed the returns for the last 2 years, they would be required to do withholding at certain amount. Uh, and this created a lot of onus on the payer in this case, as it was really difficult for them to check every time whether the payee in this case has filed the returns or not. Now this has been rationalized that if the payee has provided the PAN to the payer, then only the withhold and then no withholding, but only if they are not able to provide the PAN. then only the withholding will be required in this case. So I think this is something which will really help the businesses to smooth their processes. So we can move on to the next slide. So this is another important amendment with respect to the updated return. I think the concept, since when this concept is introduced, I think a lot of taxpayers have got benefited from that. There's, if they have filed their return, but they forgot to include any income while filing their tax return, and and s- considering that the timeline for belated returns or the revised returns were actually squeezed to a greater extent. So that really provided no opportunity to the taxpayers to disclose their tax liability. And I think the government brought a scheme that, okay, if you're able to provide your tax return within 2 years of the end of the assessment year, you can pay certain extra amount beyond your actual tax liability, and you can get your compliance done. So now this timeline has been extended for 2 more years, that you can do this compliance for 24 to 36 or 36 to 48 months, and the incremental amount that you need to pay on top of your tax and interest liability will also increase, which is 60% and 70% respectively. But I think this is something I don't think there would be many taxpayers who would be availing in the third or fourth year. I think most of them would be able to do it within the 2 years timeline. But having said that, I mean, if there is an option available, I think the taxpayers who have actually uh, omitted to include any kind of tax liability in their tax return, they would be really be able to help take the help of these particular provisions. So I think from here I will pass this on to my colleague Manish Garg, who will be looking after the provisions related to assessment and transfer pricing. Thank you, everyone.
Thank you, Sandeep. Thank you everyone for taking out time and joining us today. As you all are aware, like finance minister is going to government is going to present the new income tax bill this week. We all are expecting like this is going to be much simpler version of the law, but still there is no denial that government has been doing its best to rationalize the provision of the old income tax act as well, and it's not new to like current budget or the last budget. They have been doing it for like near to 5 or 6 budgets. Like we have seen the changes like faceless schemes, vivad se vishwas scheme, and then decriminalization of the prosecution, tedious prosecution provision. So this is all our evidences of government has been doing best to make the life of taxpayer as well as tax officers easier, and then making the law easier to comply, and reduce the litigation. Although like as a tax professional, we represent the clients before all authorities. So we also believe like the visible change in the reduction of the litigation is yet to be seen, but changes have been made, and it may take some time because the first time when the law was written and how it has evolved over the years, a lot of ambiguities have been there, and which has given rise to a lot of tax cases pending in the courts, appeals pending at the CIT level. But yes, changes are being made, and that shows the intent of the government. So starting with a block, there have been some changes in the search and seizure related assessment scheme. So this block assessment scheme, which was reintroduced in last budget in 2024, which was the full term budget for the BJP government. So why I'm saying reintroduce, because this scheme there used to be the block assessment for such cases before 2016, but that was ended, and year on year, I assessment scheme for such process was relaunched, but that did not survive for long, and the block assessment regime was relaunched, reintroduced in the last year budget. But still there were a lot of ambiguities, and industry was making a lot of representations to clarify few things which have made life of taxpayers easier. And still and government has done for the administrative convening of the tax officers as well. So talking about some key changes, so the definition of the undisclosed income has been widened to include the virtual digital assets. So now the government has really acknowledged like people are holding a lot of money or the value in form of cryptocurrencies. That's why they introduce a TDS or special tax on the virtual digital assets. On a similar line, if such proceedings are carried out and there has been a undisclosed income is found, so now it will also include the world digital asset, which was missing since before this year's budget. So, so again, there is a change in the so when proceedings or the such proceedings are carried out and they find any income which relates to the transfer pricing. For example, they find some records which pertains to tax evasion or something. So the government has amended a provision which says because it is very because the year in which the search is carried out, it may be in the middle of the year. So the government has clarified like if it pertains to any international transaction for which requires the determination of the arm's length price, the income of that particular year in which the search is carried out, that will not become part of the income of block period. It means the international transaction will be evaluated as per the normal provision, because it is difficult to determine the arm's length price for the partial year. You have to take the accounts or the comparability exercise for entire year. So this is a good clarificatory change made by the government. So now this is a big change. Big change why I'm saying this, because this will reduce a lot of administrative difficulty on the shoulders of the tax officers. So earlier, before this budget, the in the for doing the assessment for the block, for block of years, there was a timeline of 1 year. They have to complete the assessment within 1 year from the end of month in which the requisition or the authorization of the search is issued. Now what happens is we see in a lot of cases like searches happen in a group of cases, like there are the multiple assessees involved. For example, in the case of real estate groups or in case of like real estate, there's a classical example, like a lot of assessees are involved. So what happened, the government has to complete assessment of a one assessee, then they will have to pass a order, right, in within the 1 year. So what happens, all the assessments are interrelated, the same set of documents are being relied upon, so that make them pass order for each assessee every month, and then the time limit finishes, then again second month the timeline for second assessee finishes. So that was creating a duplicacy of efforts for the same matter. So that's why the government has changed the timeline. Timeline is still the same, that is a 1 year, but 1 year from the end of quarter in which the search authorization was issued. So this will give some additional room to the tax officers. They can complete all the assessment related to one group in which search requisition was issued in that particular quarter. And then if we talk about the impact and the significance of these changes, so definitely these will make the block assessment regime more robust and address the potential ambiguities, because these type of small challenges have the potential to create more litigation, more court cases. That's not what the intent of the government is. So that's why they will make the scheme more robust and challenges free. And definitely, these are again testament to the government's efforts to bring simplicity and the transparency for taxpayers. So can we move on to the next slide? Okay. Again, there are a lot of changes in the penalty and the prosecution mechanism. So starting with the prosecution, Section 276B, which talks about the prosecution in case of TCS deposit default. So if you all are aware, like in last budget, government has taken a big step with decriminalizing TDS default prosecution related matter. So, there used to be a small default in TDS deposit, and prosecution used to be initiated by the department, and prosecution is kind of a proceedings which are a significant dent on the reputation of any company, because this is not only launched on the company but on the directors of that company as well. So in last budget, considering the representation made by the industry houses, the government decriminalized the small defaults. And earlier, if you failed to deposit the TDS up to the due date of the TDS, that is the 7th of the next month, they allowed you to some more time. Like if you are able to deposit the time up till the date of due date of TDS return of that quarter, then no prosecution proceeding will be initiated against you. And that was really appreciated by the people. So similarly on that line, that same provision has been, amended in case of TCS as well. So if there is a default of TCS, but that has been deposited up to the due date of TCS return, so prosecution will not be initiated in these cases. So again, a very, very good move and will make the life of taxpayers very easy. So now this section 271 AAB, not very major impact, but this was a penalty provision in relation to search assessment, which was there before the block assessment concept was reintroduced. But that provision was still there. Government has now removed that provision. Like this penalty will no longer be applicable, because there is a separate penalty for the block period assessment scheme. So now coming to the third change on penalty, that is, earlier, like right now, like if you are from the industry or you are a professional, you would have seen like once the assessment proceedings are completed, you see a lot of notices for a different section of penalties coming in. And the timelines are also different, because if you read the penalties section, that is section 275, there are a lot of timelines. For example, in relation to any IT order, then penalty, if the penalty has to be penalty order has to be passed, there is a different timeline. In case of CIT, there is a different timeline. In case of assessment related penalty, there is a different timeline. So all were creating a lot of repetitiveness in the system. Taxpayer was also very annoyed, and tax officer was also finding it very difficult to comply. So they have brought a uniformity in the penalty provisions, be it related to CIT, be it related to IT order. If there is any penalty, then the timeline has been done to 6 months from the end of the quarter in which all order connected, I mean the penalty, all the proceedings have been finished. For example, if any ITAT appeal was pending, which has where the order has been passed and penalty order has to be issued in relation to that, so it can be done now 6 months from the end of the quarter in which that ITT appeal order is passed. So it will, reduce the administrative burden on the tax officers. So can we move on to next slide, please? Okay. So again, so there were many sections like 271C, 271CA, and like 5, 6 more sections where the authority which could levy the penalty was the joint commissioner. Now the problem what was there, the assessing authority was the assessing officer, but the penalty levying authority was joint commissioner. So it was, creating a lot of, coordination problem between the officers itself, and the taxpayer was, going to AO for the assessment, but for the penalty related representation, they were going to joint commissioner. So that's why the tax department has acknowledged this thing, and they have made sure like the authority which is doing the assessment and the penalty should be the same. That's why they have given this power to AO now. Obviously, there are certain threshold. If we cross that threshold, then AO will have to take approval from the seniors to issue the penalty, but the primary right has been given to AO now. Now, so if penalty order has been issued against you, or the prosecution order against has been issued against you, then taxpayer has a right. They can go and file a application for seeking immunity from the penalty under section 270 AA. But there are certain conditions like you should have paid the interest, you should have not filed the appeal. Then officer has a time of 1 month in which they will pass a order whether they are accepting your application or they are rejecting. I mean, that is up to the discretion of the officer to give you that immunity or not. But what was happening, that 1 month was never sufficient, because taxpayer was not given a sufficient time to represent his or her case. Only that was a formality, opportunity of being heard was given to assessee, but that was just a formality. So now that 1 month limit has been extended to 3 months. Now, if you file an application, tax officer has a 3 months to decide whether they want to reject or accept your immunity application. Now, this will give them some time. They can do a thorough investigation and then really call upon assessee to make the representation once or twice or thrice, maybe as required, but that is a sufficient time, 1 month to 3 months. So next slide, please. Okay, so now this is a very very important change, which looks very tiny, but that had the potential to create a lot of ambiguities and the litigation, and already a lot of cases were pending in the court. For example, if there is any assessment, so there is a time limit in section 153 for various assessment and the reassessment to be completed by the department. But that says there is a proviso which says if the assessment proceedings have been stayed by the order of the court, then during the pendency of that stay, I mean the court proceedings, that will not be counted in that time limit of assessment completion. Now that is very simple, but still that was creating ambiguities, because that was not clear from which day that stay will start and which day that stay will complete. So I mean, which period needs to be excluded from the time limit. So now government has issued a clarification on the start date or the end date of that stay. So start date will be when what is the date of order, which is the date of stay order which has been issued by the court, and the end date of that stay will be the date on which the certified copy of the order vacating the stay will be received by the commissioner or the principal commissioner. I'm telling you because we have personally seen cases which are lying in the courts on just small issues, like which is the date, or the order has been issued on the last date. Assessees are challenging this thing in a court or in writ petition. So again, this is a very important change and will bring clarity. So now there have been some changes in section 132 and 132B in relation to retention of the books of accounts which were seized. So what happens is when the such proceedings are carried out, so all those books of accounts which are seized, so what happened, they can keep those books of account. I mean, AO can keep that books of accounts with him till the time that assessment is completed. Once the assessment is completed, now they will have to, they have to take approval from their seniors to retain that for the more than 30 days from the time that the order is passed or the assessment order is passed. If they fail to do so, they will have to release that books of accounts to the assessee. But what happens in the cases of group searches, like we previously mentioned about, so books of accounts are interrelated. So there are records of many assessee in the single set of books of account. So what was happening? Tax officers have to take a separate approvals for the different assessees and for their books of accounts. So to bring down the administrative difficulties, they have now rationalized this provision. Like they don't need to take a separate approval. They can take a approval, so the timeline has been from the end of month. It has been done from the end of quarter, similar to what we discussed previously. So all those assessment order which are falling in particular quarter, there is no need to take the separate approval by AO for retention of the books of accounts. So this change is related to directions regarding notifying the faceless regime. So faceless regime, as we all know, have been introduced in at some level like CIT level, AO level, but still there are some authorities or like DRP or ITAT, where the faceless scheme has been talked about, but the actual implementation has not been done. So there was a cutoff date of 31st March 2025 by which the government had to issue the direction for notifying this scheme. But now the government has done away with this date. It essentially means the government will issue the direction in due course after the 31st March 2025. So can we move to next slide? Okay, so this is one of a hero change in this year budget, which has the potential of reducing the litigation to the great extent. So what happens right now? What is the mechanism of the transfer pricing assessment? Suppose your income tax return is selected for scrutiny by assessing officer. Then if AO thinks there are international transaction and the TP is applicable, then he will transfer or refer your case to transfer pricing officer, which is the expert to determine the arm's length price. So what happens when he refer the case to TPO? TPO determines your ALP, passes his order, sends back his order to the AO, and AO recompute your income by incorporating the addition what have been proposed by the TPO. That is what is the mechanism is about. Now this thing was happening year on year because there was an individual year assessment. There was no concept of the block assessment except in the such cases. So now there's change has been introduced which says there will be the block assessment for the transfer pricing cases. The option has been given to taxpayer. So now what will happen if during, so you will have, so exact time or the manner in which the option has to be exercised will be prescribed by the authorities in due course. But at least in the FAQs issued by government, they have clarified that this option will be given during the time of transfer pricing assessment. Means AO refer your case to TPO. So during that 1 year time in which TPO has to pass his order, TPO will like you will be given option whether you want TPO to determine the ALP and you want them to apply the same result in the for the following 2 years as well. So there is a block period of 3 years, 1 year for which your case has been selected for scrutiny. And if you want, you can let them apply the result of that assessment for the following 2 years as well, subject to certain condition. One of the condition is the transaction should be similar. Now, if you apply that option, TPO will examine whether your transaction for the future 2 years are same or not. Basis that within 1 month, he will give you a green signal or the red signal. Your option is validated or not. If the transactions are same, your option will be validated. I mean, detailed clarification is yet to be issued. But now the question comes whether this scheme is a success or not. If we talk about the big corporate houses which see a litigation year on year, I mean transfer pricing litigation, definitely this scheme might be a success because they might save on the lot of litigation cost. But again, this will depend on what is the timing of when you can apply that option for doing the block assessment. Suppose that option is given at the beginning of the transfer pricing assessment. By that time you don't know which side your case is going, whether you have a strong case or not. So taxpayer might not find it very lucrative scheme because they might be scared to apply for that scheme because they might think if the case goes against them, the same result will be replicated for the coming 2 years as well. They will be stuck in the loop of depositing 20% for 20% demand for all 3 years together. So that is some of the questions that that depend on exactly what is going to be the timing of applying for that option. If the option is given towards the end, like just before the issue of show cause notice, then there is certain amount of clarity that the taxpayer gets that whether they have a strong case or not, what kind of queries the transfer pricing officer has. So lot of things are going to be depend on that timing. But still we see big corporate houses might be interested in this scheme, but small and medium sized enterprises, because it is not it is not a case like every year their assessment is picked. So in case even their assessment is picked for 1 year, they still choose to remain away from this scheme in the fear if they choose this scheme and the adverse stand is taken, that will be replicated for all these 3 years. So these are all the challenges, and a lot of clarifications have to be issued by the department if they want to make this scheme work for the taxpayers. And then one thing I personally believe, if government really wants to reduce the litigation, they will have to make the quality of the assessment very, very strong. What happens in our experience, although there is no official data, but in our experience, we have seen 80% of the cases which go before the transfer pricing officer for assessment, more than 80% of the cases, see huge additions. And the relief is given only at the tribunal, at the courts level. So there is always a preconceived notion by the transfer pricing officers, because the transfer pricing is very subjective exercise. Unlike the corporate tax assessment, where you submit the set of documents, invoices, vouchers, and how the expenses have been allowed, how does it pertain to the business expenditure. Transfer pricing is very subjective exercise. I mean, there is a lot of room for the interpretation, different interpretation. So it will be interesting how this scheme like how the further clarifications are rolled out. So another proposal is in relation to the safe harbor. So there is no visible change has been made, but still in last year budget also the finance minister talked about like they are going to make the safe harbor scheme more lucrative. So we people were expecting reduction in the margins and an expansion of the scope. So similar announcement has been made in this year budget as well. They are working on making the safe harbor rule more comprehensive, more lucrative, so the popularity can be increased. But there is small changes like introduction of the surcharge on secondary adjustment. That is one of the case. So secondary adjustment is one thing, like if you make a voluntary adjustment due to APA or on your own, then you'll have to bring the money back. If you don't bring the money back, you'll have to pay certain amount, that is 18% tax you have to pay. So government has now introduced a 12% surcharge on the top of that 18% tax. So that is what the change is about. So have
Yeah, so I think Manish, thank you for this. Sandeep, I think before we start indirect tax, do you want to take the questions on direct taxes which are in the chat box, uh, so that then the second half we can take the indirect tax questions.
Yeah, sure, sure. So I think I has answered some of these questions already during my presentation. So the first
Yeah.
question is, what do you think about the new
And
tax regime?
maybe Sandeep, I can just start
Sure.
with quickly answering them,
Okay.
and you can also. I think just being conscious of time. So I think there are a couple of questions on the new tax regime. So one thing is clear: the government does not want to continue with the old regime. When the old regime was introduced, they said that they expect everyone to migrate to the new regime. They want simplified tax system, less exemptions, lower tax rate. They don't want to incentivize financial product just by taxes. And we have seen that that's why the tax rate on equity shares have also gone up. And so there's no real incentive now. So I think most of the people will take new regime. There's very less incentive unless you have a lot of legacy investments which you don't want to discontinue, and there are very heavy tax saving instruments and exemptions which you are availing of. But overall, I don't think this is going to new regime would be the future and is the future. Then there are some questions on the TDS 50,000 per month limit. I think it's per month.
So this is regarding rental. So as I clarified that the limit is 50,000 on a monthly basis, not 6 lakhs annually.
Yes, so it's 50,000 per month.
Yes.
And then on the extension of period of filing updated returns. So I don't think it will impact the revenue of the tax authority in a positive way, not in a negative way. People would contribute more if someone is trying to come on the third and the fourth year. First of all, the chances of catching them are low by the tax authorities. And if they're coming on their own, they're going to pay 60 to 70% of their tax and interest payable, which I think would impact the tax collections positively. Sandeep, do you want to take this question on NPH Vatsalya? And
Yeah,
then
so
this is
again,
the-
yeah, so it says that 80 CCD is something which cannot be availed in new scheme. And I think that is right. That can only avail 80 CCD when you are availing the old regime. So yes, there is a possibility that not many taxpayers would be able to claim this. So this is something which one needs to evaluate on an individual basis that what scheme would be beneficial for you. Right.
Yeah, and then there's a last question that cap gains are not included for calculating the exemption limit for the tax rebate which is applicable up to an income of 12 lakhs. So the answer is yes, cap gains are not included. If you only have cap gains, you will not get that rebate. So unfortunately, that's the case because cap gains are as it is taxed on a special rate. With this, I think I would just probably give it to Ikesh. Ikesh, if you can just leave 10 minutes at the end for Q&A and just some quick comments from all of us on the direct tax bill. Over to you, Ikesh.
Sure. Thank you. So, with respect to indirect taxes, we'll start with the Safari Retreat judgment. That was the with respect to returns, with respect to Safari Retreat judgment, but that was a landmark judgment which held that the input tax credit on immovable property shall be decided on the basis of functionality. And further, that plant or machinery shall not be considered as plant and machinery. And accordingly, the input tax credit shall be available on the basis of functionality. This rule provides a relief to ruling provides relief to the real estate developers and the companies who are into the rental businesses. So this provides them a relief. So, however, this amendment in the recent budget have again changed the definition to from plant or machinery to plant and machinery, with clearly mentioning that regardless of any court ruling or any tribunal decision or any court ruling that is basically to override the Safari Retreat ruling, the plant and machinery shall be read as interpreted as plant and machinery. So this ensures that a uniform applicability is there in section 17.5C and section 17.5D with respect to plant and machinery, which have already been defined under the section 17. The plant and machinery is already been defined. However, the judgment, in our view, the judgment of Supreme Court of Safari Retreat is still applicable to the extent that it is not used for on their own account, which still hold good, because that was the judgment not excluded in the amended definition as well. Similarly, Bharti Airtel judgment that the property shall be first considered as immovable property. Then only the applicability of section 17.5C or D shall be applicable, that which need to be checked. So if the property is movable, in that cases, ITC shall be allowed. So in the Bharti Airtel, like the telecom towers were there, where it was considered that ITC was disallowed, and accordingly, the judgment rules that since the telecom towers are excluded in plant and machinery definition, but these are the movable towers. Hence, the applicability of section 17.5D or C is not applicable. So, can we move to the next slide? Yeah, thank you. So now with respect to returns, there have been substantial changes which have been proposed in the budget. First, that the return of GSTR 3B cannot be filed until and unless the GSTR 2B is generated. After the GSTR 2B is generated, the taxpayer have to take an action on each and every invoice. Earlier, what was happening? That GSTR 2B is auto-populated in the returns, and the taxpayer can avail the credit and or amend these details. And if he do not want to amend these details, he can just proceed for filing the returns. But now the taxpayer have to take an action on each and every invoice with respect to they have to either accept it, reject, or consider that as a pending. Then only, and each and every invoice, then only he shall be able to file the return. So now we are moving to transaction based return or reconciliations, instead of consolidated reconciliation. So earlier, the reconciliations were that whatever the input tax credit you have claimed, if you have received any notices with respect to 2A or 3B differences, you have to explain it to the authorities that which ITC have been taken, which have not been taken. You have to submit your reconciliations depending upon the case-to-case basis. But now this shall be done by the system itself. The invoice management system shall be applicable, and it shall further add the compliance burden on the taxpayers, that they have to reconcile uh, on the invoice basis, and then they have to file the return. So can we move to the next slide? So earlier, the applicability of input service distributor was optional, but now from 1st April 2025, it shall become mandatory. Now with multiple registrations, the companies who are having a multiple registration will require to distribute their commonly procured input tax credits through ISD mechanism. And the earlier amended definition of ISD has to was amended that they can pay the taxes under reverse charge mechanism under CGST and SGST, and then distribute such credits. But the ISD was not included. Now, with the recent amendment to make it in line, the RCM is now also applicable for the IGST. With the latest amendment, ISD can now distribute the ITC tax paid. ISD can pay the taxes on RCM on CGST, SGST, or the IGST, and then they can distribute as per the registrations which are there. So this integrates the RCM provision with the CGST and SGST and removes the ambiguity. So with respect to time of supply of vouchers, there have been recent amendment of the vouchers, because there was a lot of ambiguity with respect to vouchers, that whether the voucher shall be considered as good, or whether it shall be considered as service or money, or it shall be considered as actionable claim. And there have been contrary advance rulings with that respect. So accordingly, and there have been some favorable judgments as well, in Karnataka High Court with Premier Sales Promotion and Kalyan Jewelers also, which particularly held that the voucher will be considered as actionable claim or money. As a result, it will not considered as supply of good or services. So similarly, in line with that, the circular of 243 was also issued, that which recognized that if a voucher is recognized by RBI, in that cases it shall be considered as money. Else, if it is not considered on the definition of money, in that cases it shall be considered as actionable claim. So since these vouchers are not classified as good and service, these shall not be treated as supply of good or services. So to bring the uniformity and remove the ambiguities, and to align with the circular as well, the time of supply provisions with respect to vouchers have been removed, and now taxes shall not be payable at the time of purchase of vouchers and while in the trading. So if we can move to the next slide. So this have been this have been a track and trace mechanism shall be applicable for certain goods in the recent proposed amendment. Now it is to prevent the evasion of tax. A legal framework is developed. So to implement the mechanism for tracing specified commodities through supply chain, the proposed track and trace mechanism intends to plug the revenue leakage from the supply of evasion-prone commodities. The goods and the person in respect of such mechanism shall be applicable only with the respect of notified persons with respect to furnishing of the details of such goods, and with furnishing of such details with respect to such goods, like furnishing of total installed machinery capacity, identification of the capacity. So the proposed, if you are not able to comply with the same, the penalty shall be applicable under section 122B, which shall be in addition to chapter 15 or 19. That shall be up to 1 million, 0.1 million, or 10% of the tax payable for the same. So similar mechanism was also there in the liquor, where in states where there is a revenue leakage in respect of duties of leviable on manufacturing of sale of liquor. So can we move to the next slide? Now, with respect to local authorities, recently the Delhi Development Authority has sought a clarity whether the Delhi Development Authority would be classified as a local authority, and the exemption, the services supplied to such Delhi Development Authority will be classified as exempt services. So in such cases, the circular clarified that the Delhi Development Authority shall not be considered under the exempt category, as it does not fulfill the conditions of local authority. Now, to bring a clarity in the local authority, the definition have been further amended to introduce the local funds and municipal funds, and they have been defined further so that the clarity can be brought in place to align with the circular as well. Now, there have been a recent amendment to Schedule 3, which have been clarified for the treatment of supply of goods in special economic zone and free trade warehousing zone, that any supply made before the clearance of the goods for exports or before any DT clearance, it shall not be considered as a supply. If the goods have been supplied within the SEZ, in that cases, it shall not be considered as a supply. And this amendment have been brought retrospectively from 1st July 2017 itself. This legal clarity brings that the existing provisions for GST transactions, it is in line with the High Court judgment. It is in line with the transactions as per the custom bonded warehouse provisions. It provides the clarity. Further, it also adds that the refund shall not be given if the taxes have already been paid. Now, to our view, if the taxes have already are not applicable, that case refund should be granted to the same, because it is without the authority of law. So can we move to the next slide? Okay. So amendment in section 34. So basically, is that is the credit note amendment, that in cases where the amendment have been proposed that a taxpayer's liability will not be reduced, the supplier's taxpayer liability will not be reduced until and unless the recipient who has availed the credit note has not reversed the input tax credit, and the tax incidence on such supply has not been passed to another person. If these conditions are satisfied, then only the supplier shall be able to reverse the credit. Now, earlier, the circular was issued that it mandates that the recipient, the supplier has to take a declaration from the recipient that the tax that has not been credit has been reversed for the credit has been reversed on these such inputs. If it is the amount is below 5 lakh, in that case he can give the declaration himself. If the credit is amount input tax credit is exceeding 5 lakh, in that cases they have to furnish a CA certificate or CMS certificate for the same, that input tax credit has not been reversed. Input tax credit has been reversed. But now it has been changed that the incidence of the supply has also been not passed to any other person, and it shall further apply to the post-supply documents like the volume discounts if have been applicable. So accordingly, it requires to submit a declaration. Now the transition to the invoice management system, where the recipient must take an action on each and every invoice, it remains to be seen whether the such declaration shall still be necessary. In our opinion, if credit note is accepted online and it is declaring, and when your credit note is being accepted, the input tax credit is already reversed in the return, then such declaration should not be required. But however, there have been no clarification as of now when these provisions shall be applicable. hopefully the clarity should be brought in place accordingly. So can we move to next slide? Now, in the recent amendment, when the demand pertains only to penalty and not to tax, the pre-deposit for filing an appeal before the appellate authority has been reduced from 25% to 10%, provided that no tax demand is reported. Now, previously, the 25% demand was only applicable when Section 129 is applicable. So, in other cases, if the demand is raised for any other section, demand of penalty is raised in any other section. In that cases, uh, the pre-deposit of penalty is not applicable. Now, with the recent amendment, the penalty pre-deposit of 10% is there. It has been reduced from 25% to 10%, but now it is applicable to all the penalty demands, regardless of the section under which they are raised, provided if they have not been raised under any other section. The tax have not been raised under this same. Additionally, if you are filing an appeal to appellate tribunal, total 20% of the pre-deposit is required to be paid. So that means if you have paid earlier 10% in the appellate authority, in appellate tribunal, you have to pay further additional 10% for the same. So with respect to now, the amendment is also with respect to waiver of penalties and late fees, that the government may waive off the penalties specified under section like 122, 123, 125, or late fee under section 147 for specified taxpayers. It may waive off penalty in part or in full, but no refund shall be granted for the tax paid under before section 128 came into effect. So these are the changes with respect to indirect taxes. I will happy to clarify any doubts you may have.
I think, thank you, Ikesh. Ikesh and Sandeep, do you want to take up a few questions?
Sure.
Yes.
Maybe
So,
Sandeep.
yeah, sure. So I think some of the questions relate to direct taxes as well. So I will take those first. The first question is that is there any additional deduction for contribution to NPS Vatsalya? The thing is that no amendment has been made in ATCCD with that respect. So I don't think that there will be any additional deduction, and it will be within the same limits only. Uh, I think all the other questions relate to indirect taxes. So maybe in case you can take those up.
Sure. So I will repeat the question for everyone, and then we can take up the answers for that. So if you have any further questions, then after taking the questions from Q&A, we can unmute in the participants segment. So how does replacing these section words in section 17.5D the impact of eligibility of capital goods for retrospective date? But since these will be affected after 1st April 2025, can we take the benefit of section 128A for interest and penalty? So in cases of the penalty, if you have raised, if any demand have been raised with respect to taxes, interest, and penalty, the conditions of 128A are satisfied. In that cases, you can definitely take the benefit of the same. Please check the applicability as per the new provision as well, that the amended, because the amendment shall may be approved in recent time, and then you have to pay the taxes as well. So accordingly, if any demand have been raised, consider whether if you are eligible for 128A, that is the demand should have been raised under section 73, not under section 74. The notice should be pending before the tribunal, appellate authority, or against the order. So accordingly, if it is pending, you can apply for the same. The conditions should be satisfied, then only you can go into the same. So the next question, what changes does the amendment to section 38 introduce regarding the ITC statement issuance? how does it broaden the scope of invoice management system? So basically, it broadens the scope. Like earlier, the GSTR 2B was auto-populated. You have to manage it consolidatedly. You have to check through GSTR 2B in itself and verify these details. Then you edit these details. Lot of small taxpayers, whatever the input tax credit is flowing in their GSTR 2B, take on the basis of that. They do not qualify that they do not these details were submitted on consolidated basis and not on invoice management system. And since these are done in Excel and or the other software mechanisms, so accordingly this was a details were submitted on consolidated basis. But now when the details are submitted on transaction level basis, so once you have accepted, even if it is accepted by mistake, this will flow into the transactions in GSTR 3B. Then again, if by mistake also you have selected, it will broaden the scope, and accordingly the implications will be the same. It will apply and the notices may be received on the same basis. So how does the retrospective amendment to Schedule 3 affect the taxation of warehouse? So in cases, it will affect in a way that any demand which have been raised with respect to these warehouse, any supply between the SEZs or free trade warehousing zones. So any supply made within these free sub SEZs or FTWZ. So in that cases, it shall be considered as exempt. So accordingly, any demand raised or any notices which have been raised or any cases which have been pending in courts can be dropped on the basis of such retrospective demands. However, there have been high court rulings which have been in the favor, which have been in taxpayers' favor, but this will brought the litigation to dropping of the litigations. However, no refund shall be given as per the amended provision, but to our mind, it should be the refund should be given because it is collected without authority of law. What are the implications of omitting the subsection 4 in terms of section 12 and 13 in terms of the time of supply for vouchers? How does this affect business issuing promotional discount and discount vouchers? So in cases of the vouchers have been issued, now this will bring clarity in lot of vouchers because lot of demands notices were earlier issued, and that is why I think the circular was issued before deletion the time of supply itself, because a lot of vouchers have been issued and they were considered that whether the voucher should be considered as goods, service, money, or actionable claims. So different advance authority rulings have been there, which have been contrary to the contrary rulings have been issued. So accordingly, now this will bring clarity that vouchers are considered as money, transaction in money, if it have been approved by RBI. If it is not, in that cases, it shall be considered as actionable claim. So accordingly, now the vouchers shall not be considered as the supply, and taxes shall not be payable when the vouchers are being sold. If it have been vouchers have been redeemed, only in that cases the taxes shall be paid, or any commission or have been paid or to further these selling these vouchers, the commission of the voucher, selling the vouchers, shall be considered as service. That on that GST shall be applicable. Sir, have you seen this? Can you confirm if someone's salaries of 12.7 lakh would be fully exempted from tax? Have these been covered?
Yeah, I think I covered this in reply to another question, and I think in my presentation as well. So yeah, that fact is correct that if your annual salary is up to 12,75,000, unless you don't have any other income to report, so then up to that particular limit, there will be no tax on that. But we have to consider all the incomes as well.
Okay. So next question with respect to GST is what category of goods or persons you are expecting to include in track and trace mechanism? How is it going to affect just how is going to affect the businesses, as we have already seen multiple compliances with respect to e-invoicing and e-way bills, And what may be the reason? Well, so the reason is very clear, like I cleared this in presentation as well, that to prevent the evasion of tax, like in liquor or the tobacco industry, are basically where, or there are some other industries I would like not to name, but there are the industries where there is an evasion of taxes. So in such cases, the government want to bring this track and trace mechanism, like their QR code might be there, or some other mechanism, or barcode, or some another this kind of mechanism may be brought in place, that they will check the installed capacity, what is the installed capacity, each goods have been packed and accordingly sequentially numbered, or accordingly have been sequentially the branding of identification of QR codes have been done, and while transporting, these track and trace mechanisms shall be brought in place, so that to check in place that everything is in order. Basically, not, it is not applicable for each and everything, but to specific goods or commodities it may be applicable. In addition to this, e-way bill and e-invoice, I think the e-way bill and e-way bill, maybe in future they will align with each other, and only one of them, only one, that is the invoice, shall be applicable, that should be brought in place, but that is yet to be seen. Okay, there is one more question, that after the deletion of these time of supply provisions for vouchers, how would the time of supply of vouchers will be decided now? So I think I got this answered earlier also. Okay, I will repeat it this again, that in cases when the vouchers are being redeemed against the good or services, in that cases, that shall be, and at that point of time the taxes shall be paid. So if you consider a particular transaction money, so let's say we have bought an Amazon voucher, so at that point of time it is not, no, the taxes are not payable. But let's say we have purchased these some goods from Amazon, and accordingly we have redeemed this voucher, at that point of time it shall be considered that the goods or service have been supplied, and accordingly you can pay the taxes on the same.
So I think, Ikesh, I think we have answered a lot of questions. I would probably take this opportunity to give some few comments and also take views of Sandeep and Manish on the direct tax bill. And then maybe we might close this 5-10 minutes early. So I think, so thanks a lot, Ikesh. I think this was great. So I think just on the hits and misses, I think this budget overall has been good, and I think for a pretty long time, middle class was wanting something, and they got more than what they expected for. So I think the big increase in these exemption limits for personal tax, the big increase in the rebate, and the increase in the slab rates have provided a much needed relief. So that's definitely a hit. And a lot of proposals, like I said, have been extended to 5 years. So I think better certainty, and like Manish said, decriminalization of certain defaults. I think that's definitely a trend, and prioritizing voluntary compliance. So I think these have been some pretty good wins and hits in this budget. In terms of misses, I think one definite miss has been the manufacturing concessional rate on manufacturing that has not been extended. I think that was a big that could have really made a difference, and India needs to attract manufacturing. We didn't see much on the anything on the R&D. So I think India's R&D as a percentage of GDP is always low compared to other countries, and especially when China going up in the value chain and doing high-end manufacturing, getting winning in the EV race, and now having their artificial intelligence, their own LLM. I think India needs a solid impetus for R&D, both from the government side as well as from the private sector. So it was disappointing not to see anything was done on the R&D side. And I think on the LLP, so LLPs have been taxed unfavorably compared to companies. There has been a reduction in tax rate for companies, but LLPs, which are usually used by small, medium enterprises, professionals, I think that was something which probably could have been done. And I think on the TDS rate, which Sandeep Sandeep elucidated on. Though there has been increase in the rates, increase in the exemption limits and the thresholds, but I think at least it can be simplified to a certain extent. There are a lot of rates, a lot of categories. Um, and lastly, on the TCS, I think still there is that 20% TCS. So TCS was brought in more for a track as a tracking mechanism. So if you now do an LRS for investments, you have this 20% big hit, which would be a cash flow issue, more than 10 lakhs. So I mean, you can still track, but with a much lesser percentage. So these are some thoughts on what could have been done better, but overall, I think the budget is great. It's not much to complain for. And now coming to the direct tax bill, so we now have a direct tax bill, which the finance minister has said that she would be tabling this week. So it's not a, I mean, it's not a consultation paper for seeking consensus. A lot of representations have already gone. So now it would be a bill which would come in and it would be implemented. So just wanted to take all of your thoughts on what do you think we can expect in the bill, and what do you think is probably not coming for sure. So yeah, just wanted to pick up. Any one of you can speak up and please feel free to add.
Yeah, sure. Thank you, Amit. So, I mean, reading through the media reports and the interviews by the revenue secretaries and other officials from the finance ministry, the intent of the government seems to be that there would not be much tinkering with the tax rates or the tax provisions as such. I think the idea seems to be to remove the redundancies and to make the language crisp and simpler. So even if you analyze the income tax provisions today, there are many provisions which are kind of redundant. I mean, there have been a lot of sunset clauses as well today in the income tax act. So the idea seems to be to remove all those kind of redundancies and to make the language somewhat simpler. Uh, and I think I mean, we already seen a lot of tax, I mean, a lot of revamps with respect to taxation this year and the last year. For example, if you talk about the capital gain scheme, this has been fairly revamped last year. This year, the tax rates have been fairly increased for the middle class. So I think we are not going to see much changes with respect to that, but it is expected that it is going to be somewhat simple. And I think, as you mentioned, and I think Manish would be deliberating on it, that the most important thing is that the dispute resolution between the tax officers and the taxpayers should be made more efficient, and uh, and, and should ideally be time bound as such.
Okay, thank you. Manish, anything from you?
Yeah. So what do I think is, obviously, like Sandeep mentioned, you mentioned, there is going to a lot of simplification in new bill. But if we talk about, what are the couple of changes which are the need of the hour, one is definitely you'll have to attach the maximum time limit with every income tax proceedings. Although at the CIT level, there is a time limit. Even at the ITT level, level, there cannot be limit, but at least department, CBDT has to make it officer accountable. If they are taken dates, do not file affidavit of affidavits in risk of petitions. If how the go to fit of how is is
I think there was some issue with the with Manish
Yeah,
connection.
yeah.
But Sandeep, I think we are probably not going to see things like tax consolidation,
Right.
change in how residential status is calculated, and probably how do you attribute profits to a PE. So we have a draft attribution report, but that has not seen light of the day. So I think a lot of
Right.
substantial changes, which probably we were all expecting, that's not going to come. That's what the sense is. But maybe, yeah, I think once this bill is tabled and maybe in the next few years, I'm sure a lot of these changes like risk-based audits and making officers more accountable, I think all these things can definitely be looked on. But as of now, I don't think that's coming. It would be more be of simplification of language and reduction in
Right.
volume and probably better arrangement of sections, a lot of cross-referencing which is there might get reduced. So having said that, I think we will probably close this webinar. I think it was almost went up to almost 2 hours and like to give you some time back from your evening. So thanks a lot, everyone. Thank you. And thanks to the panelists for this excellent deliberation. Uh, you will receive an email from us with a copy of the slide deck and our details. If there's anything you want to speak to us about, feel free to write any clarification you need. Thanks a lot, and we hope to continue doing this every year. Thank you.
Thank you. Thank you, everyone.